Welcome to the Crypto Prism channel. Let's take a look at Bitcoin's latest market structure. Yesterday, we mentioned that Bitcoin would decline toward the 0.786 level. The market has now fallen to 0.786 and it has already broken below it. At the same time, price has also dropped into the downside target zone I previously outlined. First, let's look at the daily time frame. 0.786 was an inevitable retracement target, starting from the high of 126,200. This round of decline on the daily chart has clearly entered a deep retracement structure. Previously, we could see that 0.618 offered virtually no support. It was directly broken through with expanding volume. This means the trend is no longer a strong pullback, but a continued decline after a confirmed trend reversal. Under this structure, 0.786 was never a question of if, but when. Yesterday, it was clearly stated that Bitcoin would move towards 0.786, and the market's response was a high-volume, long bearish candle that smashed directly into 0.786. Now there are already signs that price is breaking below 0.786. This step belongs to a higher time frame directional call that has been completely validated. A high-volume decline means simultaneous confirmation of both sentiment and structure. Last night's drop had two very critical characteristics. First, there was a clear expansion in trading volume. The candles were consecutive solid-bodied bearish candles pushing downward, not long wicks testing liquidity. What does that indicate? It means this was not retail panic selling, but trend capital actively taking profits and accelerating short positions. In a trending market, high volume does not mean a bottom. High volume combined with a breakdown means acceleration. Therefore, this high volume drop was essentially a liquidation of all previous bottom fishing illusions. Now let's look at the 4-hour time frame. On the 4-hour chart, price precisely hit the target zone that I provided. This is the most precise and impressive part of this entire move. On the 4-hour chart, after the lower boundary of the previous rising channel was effectively broken, and the pullback failed, price entered a trend-aligned, one-sided decline. So what critical stage is the market in right now? We need to calmly recognize one fact. The daily 0.786 level has been reached, but this is not a confirmed bottom signal. Why? First, the higher time frame trend has already confirmed a reversal. Structurally, highs are continuously declining. Each rebound is clearly capped at lower levels. All rebounds are merely corrective moves within a broader downtrend. This shows that the market is still inside a medium-term downtrend. A break below 0.786 means the downside space has officially opened. Within this Fibonacci structure, 0.786 is generally considered the final line of defense for a bullish structure. Once it is effectively broken, market logic shifts from pullback to full repricing. At that point, price will seek previous lows, equal distance decline targets, or key support zones from higher time frames. The third point is that this decline is structural and trend-driven, not an emotional crash. From the 4-hour structure, we can see the rhythm of the decline is organized and sequential. It is not a single extreme panic wick, followed by a sharp rebound. And what does that mean? It means the move is not finished. The structure is still extending. From here, there are two possible paths. The first path is a short-term technical rebound. A weak rebound may appear near 0.786, but it only counts as valid if downward momentum clearly weakens and on the 4-hour chart volume begins to contract. In that case, the rebound would merely be short covering and technical repair. Its defining feature is simple. The upside will be limited. It can only be treated as a rebound, not a reversal. The second scenario is that on the daily chart, 0.786 turns into resistance, and price continues lower. This is currently the more probable path. If a rebound occurs with weak volume and price fails to reclaim and hold above 0.786, followed by another high volume breakdown, then the market will enter a new expansion phase of decline. Targets would then shift back toward previous low areas and larger structural support zones. So overall, this decline was not an unexpected crash. It was an inevitable result of structure, cycle, and sentiment aligning simultaneously. 0.786 has been reached as expected, but the move is not over. What truly requires caution is whether the next rebound is real or false. In a downtrend, do not bottom fish, trade with the trend.